Hey everyone, and welcome back. So Mohnish Pabrai is of course one of the most successful investors in the value investing space. It's someone that I and many other value investors like to follow, and he's particularly interesting because every couple of weeks he does a new Q&A session where he answers in detail a lot of questions that we as value investors are thinking and would like to know the answers to. And a couple of weeks ago he posted yet another Q&A session and spoke about a ton of different topics, including things such as what are the most powerful types of competitive advantages or economic moats that we should be looking for in businesses that we invest in, as well as he spoke about the types of businesses that are far superior to businesses that pay significant amounts of dividends out to shareholders. Of course, I'm not going to cover everything that he spoke about in the 1-hour interview in today's video, so if you want to see the full original interview, I'll leave it linked down in the description below. But today I'm going to provide a summary and also my thoughts and explanation on a couple of major things that I took out of this interview. So if you do get some value out of today's video, I would very much appreciate it if you take the 2 seconds to leave a like on the video. And if you want to stay up to date with more content that I post in the future, then consider hitting that subscribe button and the notification bell so you get notified when I post new content. But with that said, let's jump into the video. The first thing that I wanted to talk about in today's video was where Mohnish was talking about competitive advantages, or wide economic moats as Warren Buffett calls them. And he had a discussion around why some industries don't have businesses that have distinct advantages and why other businesses and industries do have distinct advantages.
It's in the eye of the beholder. And I think it's in what is very useful is to just take a step back when you look at different businesses. Just take a step back on the nature and quality of the business. Buffett says that there are some businesses that are so easy to run, and that you could have an idiot running those businesses and they would just keep doing well. I mean, if you are a Coke bottler, for example, you have a monopoly territory given to you by the Coca-Cola company. You will compete with a Pepsi bottler, but you will not compete with another Coke bottler, right? And the joke with the Coke bottlers was that as the owner was dying on his deathbed, he would call his kids, and as he's taking his last breaths, he would tell them, whatever you do, don't let them change the contract. And then he would die. Okay. And then when the kids are dying, they would tell their kids, whatever you do, don't let them change the contract. And then they would die. And because the bottom line was that they had it was great because they bought syrup concentrate from the Coca-Cola company, and Coca-Cola company made a good bit of money on this syrup concentrate. That's like a software business if you really think about it. But then they control the rest of it, right? The distribution and the pricing and all of that. And because of the brand, you're not going to buy Glot's Cola, and such. So you're going to do quite well with it. So I think the thing is that when you look at a business, it's a very wide spectrum of companies. Some businesses are in this very favored situation where the moat is wide and deep and can endure for a very long time, and it generates high returns on equity. And most of capitalism is not like that.
In the stock market, there are a wide variety of businesses that have different characteristics, but only a select few businesses are in what Mohnish would call a favored position. And these are businesses that consistently deliver high return on invested capital, meaning they put money to work within the business and generate significant amounts of profit or cash flow on those investments. And they also have something called a wide economic moat, which is essentially a way of describing businesses that have something unique that protects them over time. So protects them through a variety of different economic conditions, recessions, good economic conditions, and protects them against new entering competition. Because in the business world, there are always new businesses trying to innovate and trying to compete in different spaces. And if we're going to invest in companies over 10, 15, 20 years, we need to make sure that the business has something sustainable that will protect it from competition. And when we're talking about businesses having a distinct advantage, I think the best way to think about it is, does the business have something that customers immediately gravitate towards, that they can only get that thing, whatever it is, a type of service, a product, a feature, an experience, whatever it is, only customers can get that at this specific business. So you can think of something like Google, for example, and I use this example, or I used to use it quite often. If we just zoom in on Google's search engine business, for example, they have a complete monopoly, right? They have the best search engine by far. And as a result, it's not even a question as to where you're going to search things on the internet as the market sits right now. You don't think, oh, if I'm looking for a restaurant, should I be looking on Bing or should I be looking on Google? No, you just immediately go to Google. You don't even think about it. And that is a powerful advantage in that area specifically. Of course, that's not Google's entire business, but that's just an example of, say, a service that Google provides that has a huge moat around it and means that Google search will likely be the dominant search engine for the foreseeable future. And what Mohnish says in the next clip I'm about to show you about these businesses is that these businesses are great because they could be run by an idiot. That it ultimately doesn't really matter who is running the company. If the business has a deep moat, the business will likely do well over time. Mohnish also explains that businesses with wide moats are of course the minority, and that the vast majority of businesses and even the vast majority of industries have businesses that are just not able to develop a moat. And he uses a really interesting example of a window cleaner to demonstrate this point.
Most of capitalism is dog eat dog. It's really tough. It's difficult. I mean, if I wanted to, for example, have the windows of my home cleaned, okay, I would go on Yelp and, have a few window guys give me quotes. I mean, they have to be very competitive. If they've got a really good reputation, they might be able to get a little bit of a premium for that, but it wouldn't be much. And so there are lots and lots of businesses, which is the bread and butter of capitalism, where you're just going to have to be amazing at execution and amazing at everything. Whereas the Coke bottler can be extremely poorly managed as long as the plant is running okay and you're not putting poison in the Coke bottles. Life is going to go on and it's going to do well. It may not be doing as well as it could do with great management, but it'll still do well.
And to me, this makes a ton of sense. There are certain businesses, certain services that are offered that you're just not going to develop a moat. And a window cleaner is a good example. I mean, you could be the best window cleaner in the world, but it's very unlikely that you're going to get a situation where you can do such a better job than somebody else that you could develop a moat, that it would actually be worth paying more on a consistent basis or considerably more for your services, and that you would attract a large amount of people. That's just not the nature of that market. And therefore, businesses like that, in order for them to do well over time, they have to have perfect execution, meaning they have to have a really, really talented management team. And on this point, I just want to share an example of one of my investments in my portfolio, which I think is a business that is run by a good management team, but I think it's the type of business with such a wide moat that it could certainly be run by an idiot and would still do reasonably well over time. The company is Thor Industries. It's the largest RV manufacturer in the US and in the world, but in the US market in particular, or in North America, I should say, they currently have about 50% market share. So that means that for every 2 RVs that are sold in the US brand new, one of them is going to be of a Thor Industries brand. And Thor Industries has built themselves to that competitive position, to that market share, by simply acquiring good RV companies over time. And they actually are a conglomerate of RV brands that compete independently. So they actually end up competing against each other, and they have localized managers that are in complete control of how those brands move going forward. So what you end up with is the best of both worlds. You get localized brands that can create products that are suitable for that brand specifically, but they get the benefit of being a part of a large company and achieving the economies of scale of ordering aluminium and other materials in large quantity and being able to manufacture those products in at a really low cost in large quantity. And this allows Thor Industries to stand out significantly from the vast majority of RV companies, except for Forest River, which is their other big competitor in the duopoly market. Funnily enough, it's actually owned entirely by Berkshire Hathaway. But the way they're able to stand out is because of the nature of the industry. It's very, very capital intensive, meaning it's a low margin business, and a lot of debt is usually required by RV companies to set up their business and to increase their production in good economic conditions. And it's also a highly cyclical industry that is tied to interest rates. So when interest rates go higher, or when there's a recession, people are not buying RVs. And as a result, most RV companies are in a situation where they take on a lot of debt in good economic conditions to build their business up. And when there's a recession that comes along, they start losing money, they can't pay their debts. And as a result, the vast majority of RV companies go bankrupt over time, or they are acquired by Thor Industries or Forest River. And that is a significant moat for Thor Industries. It means it's almost impossible for businesses to compete in the RV industry in the US without joining the Thor Industries team and getting access to their resources. Meaning, as new, good, small RV companies join the industry, they get absorbed into the duopoly that is Thor Industries and Forest River. And I think a business like that could be run by an idiot and still would probably be in a duopoly market situation. But to get to the title of today's video, there was one other clip from this interview that I wanted to share with you. And this is where Pabrai talks about a type of business or type of businesses that are superior, far superior to dividend paying businesses. And that might seem counterintuitive, right? You might think that, well, isn't a dividend, well, a dividend is a payment directly to shareholders. So wouldn't businesses that can deliver a lot of cash to shareholders directly, wouldn't they be the best businesses? But that's actually not the case. And Pabrai uses Tencent, which is a business that does not pay a dividend and has never paid a dividend, as an example to show you why it is far superior to a lot of businesses that do pay dividends.
Tencent basically is also a business that generates very high returns on equity, and it's not as good as IEX in terms of 80% operating margins across, but it's very healthy, and they generate tens of billions a year in free cash flow every year. But inside Tencent is what I would call Sequoia fund on steroids. So if they make 15 billion in a year, free cash flow, they have a biz dev arm that is going to take that 15 billion and deploy it into mostly private deals. And they are also very thoughtful about it. So they're not sprinkling money around to early stage businesses, etc. They focus on businesses that have achieved certain milestones and certain traction, and then they'll come in. They also tend not to want to have large stakes because they want to leave, incentives for teams. So their engine, which feeds this BizDev arm, has been very successful. They've invested in what have later turned into more than I think 15 or 20 unicorns, and they've done really well. So what I'm saying is they have an engine which takes their cash flow and puts it into other businesses, and that engine, the track record of that engine can go up against the best venture capitalists. It's extremely good, and there's no carry, so it's even better for investors. That engine that Tencent has is extremely rare. Most companies that are even really good businesses like IEX do not have the ability to redeploy the money that's coming in into other businesses.
Well, it does seem initially that it would be good that businesses pay you a lot of dividends because then you receive a lot of money. You then need to take that money and reinvest it in order to continue growing that money and compounding it over time. So ideally, you want a business that doesn't need to pay you a dividend, that produces a lot of profit, but then can reinvest it back in the business, kind of like if you had a savings account that was earning you a 15% interest rate on that savings account, right? If you had a savings account that earned you 15%, you would not want to take out that interest every time, right? If you had $1,000 invested and then the next year you earn $150 in interest, you wouldn't want to take that out. You'd want to leave it in there so the $150 can also earn interest. And the same thing applies for businesses like Tencent that have investment opportunities within their business. They're able to produce a lot of profit and then reinvest them into either new businesses or existing businesses, or to make acquisitions that deliver you that high compounded return. And this is exactly how Warren Buffett's Berkshire Hathaway was able to grow at such a high rate over time. And Pabrai talks about this as well a little bit later in the interview, how Warren Buffett would invest in these businesses such as See's Candy, and See's Candy would produce a lot of profit, but there wasn't really any internal room to grow at See's Candy. They really couldn't put money back into the business to grow it in any way. So Buffett took that profit and just invested it in another business. And as a result, if you were invested in Berkshire Hathaway for a significant period of time, then you were experiencing that compounding where you had Warren Buffett basically investing on your behalf. And that's what you want to find as an investor. You want a business that invests on your behalf. Of course, the major catch here is that the vast majority of businesses cannot find enough internal opportunities to reinvest money, right? You can have really good businesses. Think of something like Facebook that produces a lot of profit. They produced almost $40 billion in the last year, and that's up from $20 billion just 3 years ago. So clearly a really good business growing its profits over time. But at the same time, they are running out of opportunities to put that money to work in their existing advertising business, which is why their cash pile has grown to over $60 billion. So they are producing a lot of profit. They are a good business, but they would be an even better business if they had an opportunity to reinvest that $60 billion right now and earn, say, a 15% return on it. If they did that, by the way, they would almost double their profits immediately. So that shows you the benefit of businesses that can reinvest significant amounts of their profits. So that's all for today's video. I hope you guys got some value out of it. I'd love to hear your thoughts down in the comment section below.